All right. Welcome to the Annuity Researchers Podcast. I am Zachary Van Ness with Annuity Association, where our mission is to provide a better annuity buying experience. And you can find us at annuityassociation.com. Matt.
Welcome, everybody. I'm Matt Sluzer, Senior Annuity Advisor here with Annuity Association. And today kicks off our foundational series where we'll explore each major annuity type in detail and discuss the purpose they serve.
Yeah, so what we're doing today, we're really starting the building blocks of guaranteed income, and we're just wanting to share with you the traditional single premium immediate annuity and the deferred income annuity. So you'll hear us use acronyms. If we do that, just know single premium immediate annuity is SPIA, and deferred income annuity we may refer to as DIA. These are the oldest annuity types, actually. So we'll use these as reference today to start these building blocks and understanding what's out there.
During this video, we'll cover how they work, what are the pros and cons, the key payout options like life only, period certain, what do those terms mean, joint life, and different options to customize for a refund. We'll also show you how we use our software, and we'll take a look at some real examples as far as rates that are available today.
Yeah, so let's just jump right in. And what we'll do is we'll start with the single premium immediate annuity, or the SPIA. So a SPIA is the simplest form of an annuity. You give a lump sum investment to the insurance company, and they start sending you an income. That's a monthly paycheck or a quarterly paycheck or an annual, however you decide is best for yourself. And usually with the single premium immediate annuity, that income is starting within 30 days or anytime in that first year. So really think of it like a pension that you're creating for yourself. Once it starts, the payment is guaranteed. And then from there, there's no market risk or no fluctuation.
Now, a DIA is a deferred income annuity, and it works the same way, except for the income starts later. So the longer you defer the income, the higher that payout will be. And it's great for people that are planning to fill the income gap in the future. Let's say that income will start in 5 years plus. And what you're doing is you're locking in that future income stream today, and it adds a lot of predictability in your retirement planning.
Yeah, so when we're working with clients, what we're really trying to uncover is what that plan looks like for them in retirement. And really, ultimately, the underlying question is, when does a single premium immediate annuity make sense versus a deferred income annuity?
And a few ideal situations where these products may be a fit. One would be if you're looking for guaranteed income that lasts as long as you live. You don't want to have concern about outliving your money. You want to have that predictability to know that you can maintain your lifestyle throughout what could be a very long retirement. The other would be if you're looking to simplify future financial decisions. So by securing that guaranteed income stream, these products are very simple. There's not explicit fees, investment allocations. There's not a lot of moving parts. It's money that's hitting your bank account for life with a lot of predictability and keeping things very simple. The other would be someone that perhaps is looking to de-risk a portion of their portfolio and convert that into a predictable cash flow. And lastly would be maybe you need an income bridge just for a certain period of time where you're delaying Social Security and you're retired, and maybe you have a 5-year gap in between that you're looking to fill. So with these products, there's options where you can just set an income stream for a certain period of time.
Yeah, Matt, and I, just thinking offhand, there are other areas, and I think you've probably run into this, and I have as well, where we've seen a lot of value with individuals who do have a pension. Maybe that pension is offered in the form of a lump sum, or just to convert to a lifetime of income. So in many cases, opting for that lump sum payment and using it to purchase an annuity or a single premium immediate annuity or deferred income annuity through the open market can result in higher income guarantees compared to that pension that's built in for a lifetime payout.
Absolutely. We see that all the time. Well, let's take a look at our software and compare some real examples as far as what options are out there and what's available to be able to customize these contracts. And so let me go ahead and pull that up.
Awesome. Yeah, Matt, while you're pulling that up, just as a reference, really want to mention if you are getting some value out of this specific recording today, feel free to check out our website, annuityassociation.com, and check out our channel. Really, we've got other content that we're creating. So whether that's this informational knowledge about annuity types, specific products, we're launching that series where we're reviewing different annuity products on the market. And if you're just wanting to understand how annuities may help you in retirement planning, we've got videos there as well.
Yeah, thanks for that, Zach. So I'm going to go ahead and share my screen here. And all right. Can you see that okay?
Yep, you're good.
Perfect. So this is our software that will sort all of the annuities in the independent marketplace. And we can look at some examples of rates that are available today. So everything that we look at, this will be as of the rates from June 27th, 2025. Now, keep in mind that the products, the carriers, they could vary by state. The rates can vary by state. And also these rates are subject to change at the carrier's discretion before they're locked in. Also, a quick disclosure, this is for informational purposes only. If you'd like to see if these products are a good fit for your situation and your objectives, please reach out to a licensed professional to have that conversation. And so first we'll take a look at single premium immediate annuities, and that would be with the income starting in less than a year. So I'm going to put in here the income start date, and we'll set it a month out. So let's take a look at a month out from today.
And the example you're using is it a single male?
Yes, so this will be a single male, 70 years old in North Carolina. And the first type that we'll take a look at for single premium immediate annuities would be for someone that's just looking to bridge the gap for a certain number of years. And perhaps this gentleman has an income stream that's going to kick in 5 years from now, and he's just looking to get income over a period of time, or perhaps he's looking to have a number of years, or maybe he's doing more travel, able to have some more cash flow coming in. And so we can put in here certain only, and that will be just income for that certain period of time. After that point, it'll stop. And we could put a 5-year period, for example. And the reason that something like this might be a good fit is that if you had an investment where you were looking just to generate a cash flow over a certain period of time, some of the other options might not be as efficient to essentially get a fair rate of return and convert that money into an income stream. So for example, if someone were looking for CDs, they're not always as flexible as far as withdrawals, and there's some more complication that would come into play if you're looking to maybe ladder those. If the money was just in a money market account, there's not a lot of certainty there as far as what that interest rate will be. It can fluctuate. So something like this would give a very predictable cash flow for a period of time. And if we take a look at a 5-year certain only, and we'll assume $100,000 initial investment, let's take a look at how much income that would generate. So we can see our software is sorting all of these carriers in the marketplace. It'll show what the AM Best rating is. AM Best is the oldest insurance company credit rating organization. And an A minus or an A would be considered an excellent rating. An A plus or A plus plus is superior. So that's the top in financial strength among the excellent rated companies. And in this example, with this 70-year-old male and a $100,000 initial investment, he would receive from the top carrier, American National, is showing $1,849.35 per month. And that would be guaranteed for a 60-month period or 5 years. And we set this to begin 1 month out from the purchase date. So what would happen is a month out from the purchase date, that money would start hitting the bank and it would continue for the full 5 years. After that point, the income would stop and there would be no residual left over. So that's converting this $100,000 into that monthly income stream for the 5-year period. So pretty simple structure there.
All right. Now, one element that does come with that is you can assign a beneficiary in this situation. So with that, if something were to happen to you during that 5-year period, whatever is remaining in that term, in that 5-year period, those payments would continue to the designated beneficiary.
Great point there. So
yeah, just staying on that one, if you don't mind, just, another time that I've seen this beneficial, if it's just a little bit more of a challenge to manage, funding a 5-year period on your own, is this takes the question marks out of it, right? So it allows you the ability to plug and play, less stress. So if you want to take some of that weight off your shoulders of how do I manage this monies during this gap of time or during this 5-year period that I need it, don't get me wrong, you can do it on your own. But if you wanted something that was simplistic and in place, you're earning some interest off of it, this may be a solution.
And one thing to note as we look here, so this is assuming non-qualified money. So that would be regular savings. Now, of course, from a tax standpoint, that money has already been taxed. So as you're receiving the return of your initial investment, that would not be taxable. And we can see here that it's showing what the gross monthly income is, and then it shows what the monthly taxable amount would be. So they'll essentially track how much of those payments are just a return of your initial investment and how much of that is interest, so to speak, that would be taxable. So that's called an exclusion ratio as far as how much of that is excluded because it's just a return of your initial investment.
Right.
And the other area where I've seen these products be a fit for clients is perhaps someone has an annuity that they've had for a number of years and they have some gains that are built up in that contract and they want to exit that product, but they don't want to have the big tax hit from taking a lump sum. I will see where they may exchange that into something like this so they can receive that cash flow spread out over a number of years just to spread out that tax liability.
Mm-hmm. Yeah.
So now let's take a look at the lifetime income options. And we can see that there's a few different options here. There could be single life income or joint life between spouses. And the most simple form, as far as someone that's just looking for the highest income possible through the rest of their life, they're not as concerned about legacy. They really want to maximize that income and just take away that risk of outliving their money. So that would be a life only SPIA. And we'll put in here just to compare what that rate looks like. This is single life for a 70-year-old male, $100,000 investment with income beginning 1 month after that purchase. And let's take a look and see. Let's put 0 period certain. Okay, so this is life only. We can see as far as the top rates that are available. So we have Equitrust up here, Minnesota Life. So the very highest income from Equitrust is $736.33 per month, and that would be guaranteed for life. So that would continue as long as this gentleman lives, and if he passes, that income would stop and there would be no residual left over in this case. So that would be the life only SPIA.
Yeah, and just keeping on that, when we look at this and how this is utilized, oftentimes we have a question of, okay, well, what is the actual cash flow behind this, right? So what am I actually netting as my return, if you will? So from an annual cash flow perspective, you're looking in this scenario, again, using this as an example, it's over 8.8% annually. So that may add a lot of value in somebody's planning for that retirement.
Yeah, great point. And if you're able to receive that very concentrated cash flow off the set investment, and perhaps you have other savings available, that you could just allow that to grow and compound untouched. So that's how you create that optimization between setting up your essential foundation of income while allowing the rest of the portfolio to grow, to help for the legacy side of things, or to help to keep up with inflation. So that's how it works in combination in a portfolio.
Yeah.
And now these numbers we're looking at, these are level lifetime income amounts, where once this begins, that would remain consistent for life. There's also opportunity for these to include a COLA, where if you wanted to start with a lower income amount and have that grow over time, you can put in there to have that COLA in there where it increases each year. And so this was the single life. Now there's some guarantees where if you're looking for a competitive income, but maybe you want some guarantees where if you haven't received a certain amount of income, that there would be some level of death benefit to your beneficiary. The first type of guarantee is what's called a certain period. And so, for example, we could put in a 10-year certain period, where if you start receiving your income and God forbid you pass within, let's just say 5 years in, they will continue paying out the income through the remainder of that certain period to your beneficiary. And in the example of a 10-year certain period, you would receive, there would be 5 years of additional payments made to your beneficiary if you pass 5 years in. Now let's take a look at an example of the income amount for that. And so we can see it's a different carrier that is the highest rate with that 10-year period certain. Different carriers will be more competitive depending on the options that you select. And that's why it's really important to work with an expert that is familiar with the different nuances in the marketplace. We can see that Nationwide has the highest rate in this example, and it's a bit lower income as opposed to the life only because of that additional guarantee. And that would be for a 10-year certain period. This certain period, there's different ranges that could be selected. It could be 5 years, 10 years, 15, 20. So it's just really dependent on what type of guarantee that you're looking for. Now, of course, the longer that certain period is, you would expect the income to be a bit lower. So next would be what's called a cash refund. And this cash refund is if you have not received your initial investment back through the income payments and you were to pass, any difference would go to your beneficiary as a lump sum. So let's take a look at the cash refund. And so we can see it's Athene at the top with the highest rate as of today. And it's $687.71 per month on a $100,000 investment. And we can see with that cash refund, it's a bit lower income as opposed to the life only. So that would be in exchange for that guarantee. But that provides a lot more certainty where you know that at least you would receive your initial investment back if something happened to you.
Yeah, this is really where the software and the advisor can flex a little bit. They can flex their muscles and their knowledge, and just that in 3 different scenarios, we saw 3 different carriers as the top option. Now, I'm not saying that always is the top option going to be your choice. There are other parameters that we look at. Sometimes that carrier is more important to an individual than the overall dollar amount being received every month. Maybe that carrier rating is important. So just utilizing this and having the access to a tool like this is a huge benefit for an individual making that decision. And part of our practice is to share this with you like we're doing here on this podcast, right? But with our client meetings, we share this with you firsthand so you can see your individual situation and what that might do for you.
Yeah, thanks for that, Zach. So let's take a look at the last option to customize, which is called an installment refund. And the installment refund, it's a similar concept as cash refund. If you were to pass before your initial investment is dispersed to you through the lifetime income payments, the difference would go to your beneficiary. The difference between the cash refund and installment refund, cash refund, that difference would be a lump sum. Installment refund is where they would take that difference and continue paying out the same income payments to your beneficiary until that full initial investment has been completely dispersed. So if we look at the installment refund, we will see that it will be a little bit higher than the cash refund. Same concept, it's just that difference would be dispersed over time. And so with this example, Penn Mutual is at the top here, $697.46 per month.
Awesome.
And that would be all of the immediate annuities, single premium immediate annuities. The same options apply for deferred income annuity. The difference is with a deferred income annuity that you're planning to start that income at least a year out from the purchase date. And as you delay that out, that income amount will be higher than if you started it immediately. So we can look at just a quick example of the life only. And we'll set the date here. Let's put it starting, perhaps you were looking to start income in November of 2026. And we can see it, there's a little bit of a shorter list here of carriers for the deferred income annuity, but we can see that the income amount is a bit higher in that scenario. So while you delay that out, that income amount will grow. And it's where you can have a very predictable cash flow that begins sometime in the future, a year or more out.
That's right. Awesome. So yeah, what we'll do with these annuities, what we'll do is we'll wrap just a quick rundown of the pros and cons and ways in which they can be used. So really the pros for a single premium immediate annuity and deferred income annuity: competitive guaranteed lifetime income. We've seen that across the board. There are a few options out there for annuities that offer that guaranteed income. Competitive, it can also compete with someone's pension that they may be getting. So we'll take a look at that. Simple structure. So really not many moving parts, like an example that we had talked about, the period certain, where it gives us a set dollar amount. We know exactly what to expect for a 5-year period or for a lifetime. Very little moving parts that come with it. Also really no market risk, right? So we're not concerned about what the market's doing. You know, we've talked before about this. I've mentioned this in a few meetings where go out on the golf course, enjoy the day. I'm not worried about the market. I can focus more on my golf game as opposed to checking my phone every other hole to see what the market's doing that morning. Now, feeding into that, we talked through the pros. We understand its utilization. There are some cons that come with it. We've got to be frank and transparent with this, and just that there is less flexibility. So if we're looking at annuities, understanding its tool and what its intended purpose is, setting up an annuity for its intended purpose and letting it do its job is what's most important, because provided these annuities have that intended goal and they use exactly what they're made for, they can do a great job. But in this annuity type, less flexibility. Many contracts are irrevocable, meaning that if you start that income today, 2 years down the road, typically you can't just walk away from it and say, hey, give me the rest of my money back. So once you start it, you have limited flexibility to cancel, take any additional withdrawals, or change the terms. Although there are a handful of contracts in the marketplace that do offer some additional flexibility. So if you're comparing these annuities, make sure you work with an expert who has the knowledge and some of the nuances in the marketplace to better understand what may work for your goals. Lastly, the other key con here is that it may not have a death benefit, and that's going to be based on the decision you make at the time that you purchase that product. Although there are some options to customize for a death benefit in exchange for lower income guarantee, you've got to know going into it, once you make that decision, that's it. Wrapping up, just our final thoughts. Single premium immediate annuities, or SPIAs as you may hear, and deferred income annuities, or DIAs, are the original annuities and really still some of the most powerful tools for retirement income.
And if you want to learn more about annuities and whether an annuity would be a good fit for your situation, feel free to visit our website at annuityassociation.com. You can request a free annuity report or schedule time if you'd like to meet one-on-one with myself, Zach, or someone from our team. Please check out our website.
And we are the Annuity Researchers. I'm Zach Van Ness.
And I'm Matt Sluizer.
Signing off. We'll see you next time.
Thanks, everybody.